So we continue with topic 5, which is the last topic of your cost accounting module. So which is this is part 2. Right. So previous lecture was a part 1 for topic 5, and this is part 2. So I give quick glance over the previous lecture that we studied. So in the previous session, we first of all learned about cost allocation method. So we have two types of method: absorption costing and a marginal costing. Right? In absorption costing, we focus on the full cost, which means fixed cost will be part of your manufacturing, right? Because fixed and variable both known as a total cost. So that's why when we are estimating manufacturing costs, we have to add the total total manufacturing cost in order to estimate the gross profit. Then we moved on to the marginal costing. So under marginal costing, we estimate manufacturing cost without fixed cost, because there is an argue that there is no any contribution of fixed cost in order to maximize production or sales. By that reason, fixed cost must be excluded when we are estimating manufacturing cost. So the idea is that when we are estimating contribution margin, we have to focus more on the variable cost, right? No matter variable manufacturing, which contribute to maximize the production, or variable non-manufacturing, such as marketing and advertising, which directly maximize the company revenue, right? So that's mainly the ideas or the difference between marginal costing and absorption costing. Then we moved on to the cost volume profit analysis, which means break even. So fixed cost equals to contribution margin, known as break even, right? And then we looked at break even sales in units and in dollars, right? And then later on, we understand this break-even analysis through graphical representation. So we draw the graph in order to understand that's which portion or which area will be considered as a profitable area, which one is a loss, and where is the break-even points, right? And the third learning outcome that we focused on was a target profit, right? So in order to estimating target profit, how many sales units we have to sell, or how much revenue or sales we have to generate, so we can achieve our target profit. So we looked at the formulas, which is mainly fixed cost plus profit after tax divided by contribution margin ratio for dollars, or contribution margin per units to estimate target profit in units, right? Now we move on to the last learning outcome. So number 4. So number 4 is about different decision making. Different decision making. Different decision making. So different decision making means here we gonna look at 3 or 4 different kinds of situation, also a practical situations in which company they analyze its cost in order to make a right decisions, right? So remember, topic 5 is about cost analysis by the management in order to make a decisions, right? Cost analysis by the management decisions. So in order to understand different decision making, we need to understand or repeat something about cost, right? So cost, you know that there are 2 types of cost: fixed cost and variable cost. Fixed plus variable is a total cost, right? Remember, variable cost known as a relevant cost. It's known as relevant cost, and fixed cost known as irrelevant cost. Right? Now, relevant cost and irrelevant cost. Now, why variable cost is relevant cost? Why we call it relevant cost? The reason to call it relevant cost, because variable cost is useful when we make any kinds of decisions, right? So variable cost is important or is useful in decision making. Variable cost is useful in decision making. That's why we call it relevant. Why useful? I will explain you later. Why fixed cost is irrelevant cost? Because that is useless, right? It's useless in decision making. Okay. Now, what does it mean useful? Why variable cost is useful in decision making? The reason is, what is the nature of variable cost? Variable cost nature is unstable, which means is change as per the level of activities, right? It's change when you change your production method or you change anything. So can we say that variable cost is a controllable cost? It's controllable cost. It's controllable means we can control it. All right? Variable is in our hand to minimize variable cost. So remember the diagram for the variable cost? Here, that's variable cost. If level of activities increase, your cost increase, right? Level of activity increase, cost increase. Level of activity decrease, cost decrease, right? So which means we can control this variable cost by making changes in level of activities, by making changes in production, by making changes in labor. It's our hand. So that's why it's controllable, all right? Fixed cost. Fixed cost. This is fixed cost. No matter level of activity increase or decrease, fixed cost remain unstable. So can I say fixed cost is uncontrollable? It's uncontrollable. Uncontrollable means it's in our hand. It's not in our hand. It's not up to us that whether we can increase or decrease. It's happened. It's always happened. No matter production increase, production decrease. No matter level of activity increase or level of activity decrease, is always occur. That's why fixed cost known as uncontrollable cost. Okay. Now, you know that it's obvious that whenever we going to make a decision about something, if any kinds of cost we can control, we have to think about it, that how we can control. I repeat, when we're gonna make a decisions, right? Decision means, let's say we're gonna spend money to buy a machines, all right? spend money to buy a machines, right? So we have to find the machine which is more productive and less expensive. Now, what does it mean less expensive? Less expensive means you have two machines. In this two machine, some kinds of cost we can reduce. We can pay less to acquire these two machines, and some kinds of cost we cannot reduce to acquire this machine. So the idea is, when we make a decision, we have to think about variable cost, how we can minimize. We should spend our resources, our time, or we have to make efforts to think about that how we can reduce variable cost, how we can reduce it. So that's why variable cost is relevant for decision making. Variable cost is important, or is really useful to know about variable cost, because we can control it, we can reduce it. But fixed cost, we cannot control, we cannot reduce it. So we don't have to spend time, money, or resources to know how we can control. All right, so let me give example. So the example of variable cost is a direct material cost. All right, an example of fixed cost is, let's say, depreciation. All right, so depreciation. So can we decrease our direct, so I shouldn't write material, I should write direct labor. I don't know why I write materials. It's a direct labor, sorry. It's a direct labor. Right. Question is, can we control our direct labor cost? The answer is yes. So when we are recruiting labor, when we are hiring a direct labor to produce product, so we have to think about those people who are multitasking, who are more productive, right? So we have to think that which kinds of people can help us to work more productive. As a result, our cost will be low, output will be high. All right, so the idea is, can we decrease our direct labor cost by hiring someone who can be more productive? The answer is yes. So we have to think, when we are making a decision, we have to think how we can reduce our direct labor. So that's the meaning of variable cost is relevant in decision making. Now, depreciation. Can we decrease depreciation cost? Answer is no. We cannot decrease depreciation on machines. Why? We produce or we don't produce. The value of machine decrease over the period of time. That's known as depreciation. So we don't have to spend our time and resources to find the way to reduce depreciation, because depreciation nature is fixed. It's not controllable. So we don't have to spend our time and money to think how can we minimize our depreciation. That's why fixed cost or depreciation cost is irrelevant, is not important in decision making. Ignore it. Don't think about it. Just leave it. All right. So that's another nature of fixed cost and variable. Fixed cost is not useful to make decisions. We don't have to think, how can we control fixed cost? Because it's uncontrollable. But when we are making a decision, we have to worry about only variable cost because it's controllable. We can find another option that help us to minimize our variable cost. That's why variable cost is a relevant cost. There is another name of relevant cost. We also call it avoidable cost. Avoidable cost. Avoidable means we can avoid it. We can reduce it. We can minimize it. We can decrease it. All right. So relevant cost is avoidable cost. All right. Not avoidable at the time of decision making. I mean, relevant cost is nature is avoidable. Avoidable means reduce, less, minimize, decrease, right? And irrelevant cost is unavoidable. It's unavoidable. All right. Okay. So that's the ideas about fixed cost and variable cost, understanding of fixed and variable cost when we are making a different decisions. All right. Now, I will move on to the 4 different kinds of decisions. In these 4 different kinds of decisions, we will study that how company they use fixed and variable cost, or how company analyze cost, which is fixed and variable, to make a right decisions. All right. So let's move on to the first method. So let me write down here. So we have different decision making. We have 4 methods. Right? We have 4 different decision making methods. All right. So which means 4 different kinds of situation in which management need cost analysis to make a right decisions. All right. So let's start with A. So this one is name is one time special order. One time special order. Now, what is the meaning of one time special order? For example, my company I have a business, and in my business, normally I produce a chair. That's my product. That's my regular product. That's my regular product. That's my main product. That's I produce time to time or every day, and customer comes and customer buy. All right. One day, so chair. One day, one customer comes to my business, my shop, and that customer order that chair with wheels. So normally that's chair without wheels. My main product is chair without wheels, right? But one once a time, one customer comes to my business, all right, to order a to to order a special product. Order a special product. That special product is chair without wheels. Why we call it special product? Because this is not my regular product. That's not my regular product. That's not my main product that normally customer would buy. This is kind of special product. We call it one-time special order. So now the question is, I should accept this offer or reject. I should accept to produce this chair with wheels, or I should reject this offer. So now I have to make a decision, accept or reject. All right, I repeat, this is not my main product. Once a time, one customer come, can you make this product for me? And I have to think, yes, I can. I have just to add some wheels, right? So my worker have enough skills to make it. But now the question is it really profitable for me? Because that's normal product which is producing chair, it's a profitable for me. But this chair with wheels, I have no idea. Is it profitable or it will, I mean, it's not profitable for me. I have to calculate. So when I calculate, so what I have to do, of course, I have to find a selling price. And of course, selling price of this product will be higher than this product, right? I find my sales. Then how to calculate profit? Then I have to find my cost. All right, I have to find cost. Okay, then I will calculate cost for this product. I will focus on variable cost only. Variable cost only. I will not focus on fixed cost because variable cost is relevant. All right. Why I should not focus here fixed cost? For example, this is my business. That's my shop, right? That's my shop. In my shop, I pay rent. I pay rent for shop, which is fixed cost, all right? And in my shop, I have a machine that makes furniture, chair, or other things. So that machine has a depreciation, right? So depreciation nature also fixed, all right? Okay. So the idea is, doesn't matter. I produce this product or this product. I always have fixed cost, right? No matter I produce chair, that's my regular product, or chair without wheels. In both cases, I always have to pay fixed cost. If I'm not producing chair with wheels, do I have to pay rent? Yes. If I'm producing chair with wheels, do I have to pay extra rent? No, but still I have to pay rent. So nature is fixed. Okay. For this, if I produce this chair with wheels, so means I have to spend extra direct material cost. I have to pay for extra direct material, which is wheel, plastic, or whatever. I have to pay extra direct labor cost, right? So this is extra. This is extra compared to this. So which means if I produce chair with wheels, my variable cost increase. If I produce chair with wheels, my variable cost increase. If I will not produce chair with wheels, I produce only this chair, I don't have to pay extra material and extra labor. All right. So that's why only variable cost is important. We have to think about variable cost. We don't have to think about fixed cost. And then after doing so, I will estimate, is it profit or loss? Is it profit or loss? This is actually, we don't call it profit because sales minus variable cost, we call it contribution margin, right? Is important. We will estimate contribution margin. If it's profitable, I will accept. If it's not profitable, I will reject. That's the ideas behind one-time special order. All right. So this is the way that we are estimating one-time special. I mean, we are making a decisions using cost analysis. All right. That's the meaning of cost analysis in decision making. All right. Now we move on to second decision making. Okay, before we move on to second decision making, do you have any question? Do you have any question regarding one-time special order? Anything is unclear to you? Keep in your mind, in this one-time special order, we will not study about a calculation. We just more about theoretical way. All right. So any questions regarding one-time special order? Please say something. Any question? Yes or no? So we move on if no question. Okay. So next is someone maybe have question. Yes, anybody has any question? Somebody send me a message, any question? Price do not include fixed cost. What do you mean by price don't include fixed cost? What do you mean by price don't include fixed cost? You mean when we calculate the price, we will not use fixed cost? Yes, we will not use fixed cost. We focus only on variable cost because variable cost is important, right? Variable cost is important in decision making, not a fixed cost. So let me give example. So we have sales minus variable cost is contribution margin minus fixed cost is a net profit or net operating profit. So I have two products. One is only chair all right? Another one is chair with wheels. So I have chair and I have chair with wheels, right? If I produce this chair, I have some sales, right? Some sales, some variable cost, and this chair, this is, remember, it's my normal product, regular product, normal or regular product. This is my special product, special order, right? This is special order, right? So we got contribution margin here, and then in regular product, of course, I have to pay some fixed cost to get some net profit. All right. So I'm answering your question. So one student asked me, please send, whenever you send any question, please send these questions to everybody so we can understand. Right. Student asked me this question. So I'm answering your question as well. So when we calculate profit for chair with wheels, right? So of course I have some selling price because the price I'm selling at. I have to pay some variable cost. Then I have some contribution margin here. Then my fixed cost will be zero because no matter I produce this or this, my fixed cost so contribution margin minus fixed cost is now I have a profit. So that's what I'm trying to say, that when we have a special order, we have to ignore the fixed cost because that's not important. No matter you produce special product or not special product, this cost is irrelevant, right? Now, if I calculate my total profit for both product, chair and special order, so if I calculate my both product, so sales, selling price for this, selling price for this, so total sales, variable cost for this, variable cost for this, contribution margin V plus, right? And fixed cost only here, because here we don't have any fixed cost. There is no any additional or fixed cost for this kind of special order. So fixed cost. And then we will see net profit. If here you have loss, if here you have loss, so this net profit will reduce, because let's say you have $10 profit and $10 profit from regular and $2 loss from special. So your profit, your final profit is $8. So which means this special order is not profitable, right? Not profitable. So I should not accept this order to produce product. That's the meaning of relevant, and irrelevant cost, right? That's the meaning of relevant and irrelevant. So you can see that fixed cost is not important for decision making. When we are making a decision whether we have a profit or loss, don't worry about fixed cost. Ignore it in the case of one-time special order. That's the ideas behind one-time special order, right? So any question? Anybody has any question? Please ask me if you have any question. Any question, or we move on? Move on to B. Say something, any question, or we move on?
Yes, I have a question.
Okay.
If the net profit of normal product is lost,
Okay.
how about fixed cost or in special orders?
Again, fixed cost is zero. Fixed cost always zero. Doesn't matter you have normal have a profit or normal have a loss. Let me give you example. So let me give you one example. Uh, so you said normal has a loss, all right? So I will write down here loss. So let's say $10 sales. I'm talking about normal. $10 sales. Variable is 7, contribution margin 3, and let's say fixed cost is 5, right? And I have a loss. When you calculate special order, it has a special selling price, special variable cost, special contribution margin, and of course, zero fixed cost, right? So when I calculate my total profit, so total profit, this plus this, this plus this, this plus this, here only this, all right? So don't worry, normal has a fixed or not, it's not important. We are talking about special order, because if your normal has a loss, your normal product has a loss, we will not produce chair, because producing chair is not profit for my business. I find another business. So normal business means normal product I'm selling and I'm making money. All right. Let's say I sell hamburger. I sell I sell chicken hamburger. That's my normal product. And I decided to sell uh, beef hamburger. All right. I decided to sell beef or fish hamburger. So if chicken hamburger is a profitable for me, that's why I'm selling chicken hamburger. If chicken hamburger is not profitable, I'm not going to sell it. So my regular business is a chicken hamburger. One day, one customer comes to me and said, can you make a fish hamburger for me? And I said, okay, let me think. Making a fish hamburger is a more profitable or not? So I have to calculate additional direct material cost, additional direct labor cost. But I don't have to worry about fixed cost, like as my shop rent. Doesn't matter. I produce chicken hamburger or fish hamburger. I have to pay rent. So rent will be unaffected. It's not useful when I'm calculating the profit for fish hamburger. That's the ideas behind it. So you said if I have a loss in normal business, normal product, so that's not my product. I won't produce it because I have a loss in that business. I do some other business. All right. Is it clear?
Thank you, sir.
Yeah. Anybody else? Any other question regarding A? Or we move on to B? Can we move on to B? Please say something. Can we move on to B? Yes or no? Then we say something. Okay. Now move on to B. B is constraint, resources. constraint resources. Now, what does it mean, constraint resources? Constraint resources, the meaning of constraint is a limited resources. Limited resources. Limited resources means we have any kinds of resource which are limited. Let's say machines. For example, my machine in one day can run maximum 10 hours. So that's the example of constraint resources, limited resource. You don't have an unlimited resource. You have a limited. It could be material, it could be labor, it could be anything, right? So if your resources are limited and you have two different products, product A and product B, which product we should produce first, A or B, right? So let me give you example. So product A is chicken hamburger. I produce chicken hamburger. And product B is a fish hamburger. I have two different products, right? Chicken and fish. What is the common raw material? What is the common raw material in chicken hamburger and fish hamburger? The common raw material is a bread, right? Right, bread. So just for example, let's say I have a limited breads. I have a limited breads. So let's say my breads are 10. I have a limited breads 10. So in this 10, I can produce either 10 chickens or chicken hamburger or fish hamburger. Maybe 10 chicken or 10 fish, right? Now the question is, how can we estimate, how can we calculate, should we use chicken hamburger? Should we sell chicken hamburger first, or we should sell fish hamburger first, right? In order to calculate this, what we will do, we will rank the product using contribution margin. Using contribution margin, we rank the product. Rank means if, let's say, chicken hamburger has a rank 1 and fish hamburger has a rank 2. So I will produce chicken hamburger first. If bread left, then I will produce fish hamburger. All right? Now, for example, now customer comes to me to order 7 chicken hamburger. All right? One customer comes, he said, I want 7 chicken hamburger and 5 fish hamburger. So which means customer order for 12 products, 7 chicken and 5 fish, right? 5 fish. Now the question is, can we produce 12 hamburger? The answer is no. Why? Because my breads are constant. That's the meaning of constraint resources. My breads are constrained. My raw material, constraint, limited. So should I produce chicken first or fish first? If you produce chicken first, which is 7, then you will produce fish only 3 because my resources are 10. If you produce fish first, then you will produce only 5 chicken, again because my resources are 10. So what we will do, we calculate which product is which product has the highest contribution margin. So you calculate selling price of fish, variable cost of fix, and contribution margin. You will do for chicken and you will do for fish, and then you will see which one has the highest contribution margin. So let's say chicken hamburger has a high contribution margin. So I will produce 7 chicken hamburger and I will produce 3 fish hamburger. And now I use my all resources. That's the ideas behind constraint resources. So the conclusion is, when we are estimating which product is a profitable, we focus only on contribution margin, not fixed cost. All right, not fixed cost, because doesn't matter you produce chicken or fish, fixed cost exist. So you cannot make decision using fixed cost. You have to keep aside when you are deciding I should do this or I should do that. All right, that's the ideas behind constraint resources. Is it clear? Is it okay, constraint resources? Say something. Is it okay, or we move on? Any question, or we move on? Say something. Any question, or move on? So we move on. Has question? Yes, move on. Okay. So move on to the next. Is a C, which is in-source versus outsource. In-source versus outsource. Insourcing versus outsourcing. Now, what does it mean, insourcing versus outsourcing? It has another name. We also call it make or buy decision. Make or buy decisions. That's another name of insourcing versus outsourcing. What does it mean? For example, so I take example of hamburgers. So for example, my product is a hamburger, right? That's my product. So if I want to produce this product, of course, I need direct material, direct labor, and some kinds of overheads, right? So what is my direct material? My direct material is a bread and chicken and so on. So I'm talking about just bread here. And then we have some labor and some overheads, right? Now, this is my material, bread. Now I have 2 options to get this bread. Option 1 is I make this bread in my shop. I make my own breads. Then I use these breads to make hamburgers. So this is called make or in-source, right? Or my second option is I buy. I buy these breads from bakery, all right? I buy from bakery. So which is outsource. So which means I buy breads, I use it to make hamburger, right? Now, which option you have to make decision here. You don't have to make any decision here. All right. Here you have to make decision whether you wanna make it or you wanna buy it. All right. So what you're going to do, if you will make it, if you make it, you have to spend direct material and direct labor. You don't have to pay for fixed cost, let's say depreciation and rent. Doesn't matter, you make breads in your shop or you buy breads from your shop. Still you have to pay for rent. All right? So you don't have to pay rents when you make it. But when you buy it, if you buy, then you don't have to pay direct material, you don't have to pay direct labor. Just you have to pay the price. Pay the price. Pay the price to buy bread. So the idea is, if you choose this decision to buy, you will save variable cost. You don't have to pay variable cost, which is direct material, direct labor. And means you're saving some money. If you make it, then you will pay variable cost. But of course, this option may be cheaper. This option may be cheaper compared to buying option. Why? Because the person who is selling you breads, he add profit in the cost. But here, only cost, because you don't have to add profit here, because you are making for yourself. You're not making to sell outside. You're making for yourself, all right? When you make for yourself, you don't worry about profit, all right? This is important for profit, all right? But when you are making your material at home, you don't have to worry. But if you look at this person, when this person will sell you breads, this person gonna add profit to the cost. So that's why this person will sell the price. So maybe this money could be higher than this money, all right? So conclusion is, no matter you choose option A or option B, you have to find which option is cheaper. Which option is cheaper? You make raw material or you buy raw material. If you make, whichever is the low cost, it overall is good for your total cost. Because if your direct material cost decrease, your total cost decrease. If your direct material cost increase, your total cost also increase, right? That's the ideas behind insourcing versus outsourcing. Some people, they prefer outsourcing. They prefer outsourcing. Maybe they don't have enough skills, enough laborers, or enough weight or machines or equipments to produce it, so they prefer to buy outside, and which is much more convenience. You can see most of hamburger shops, Majority of hamburger shops in Ho Chi Minh City, what they do, they buy breads from bakery. They can make breads in their own shops, but they think they have to buy some equipment, some laborers, so on. So it's gonna be more expensive for them. So for those shops, they take outsourcing in relation of breads. So outsourcing breads. All right. So this is the ideas behind insourcing versus outsourcing. This method just can be applied for direct material or all kind of any kinds of cost, not just direct material. So let me give example. This method can be applied for direct labor. Direct labor. Direct labor means, for example, you know, contract. You sign a contract from someone else who comes to your company, make product and go home. Just sign contract for 1 month or 6 months. Or you can hire a permanent employee. If you hire permanent employee, your own employee, every month you pay money. This is called insourcing. If you sign a contract for 6 months, you hire a professional people. You hire a professional baker who comes to make product for you. And after contract finish, that person will leave. But, or you can hire a permanent worker. You hire a permanent worker. For this permanent worker, you have to give them training. You have to give them bonus. You have to give them incentives. You have to give them some commissions. But for outsourcing, you just pay one money. You don't have to give them training because they are professionals, right? You don't have to give them incentive, bonus, commission. No, because you sign a contract. In that contract, you are giving only that money. You are not paying something extra. But for insourcing workers, you have to pay them extra, right? Maybe insourcing, which is permanent workers, they could be cheaper. Maybe because you have to pay them less salary because they are not a professional. You have to train them. You're training, give them training first, and then they become your permanent employees, and time to time, their skills improve. But it takes time, right? But for professionals, they only give outsourcing service. You hire them and they will give you service, right? So no, it's not just about direct material. It could be direct labor, right? Let me give you one more example. So let's say you have a company. You are the boss. You are a director of company, all right? Now, you need accountant. You need accountant. So let's say you need financial accountant. Financial accountant is a person who prepares financial report, financial statement, right? Now you have two options for get service regarding financial accountant. Option one is you hire an employee, hire an employee, a permanent employee as an accountant. You give them salary every month. Option one. Option two, you contact a big four. I hope you know big four: KPMG, Deloitte, PwC, and EY. All right, so these are four big four companies. They involve in some kind of financial services, accounting and auditing and taxation, or some kinds of other legal services. So you contact big four that at the end of the year, someone comes from big four, prepare your financial statement, and you pay them money, contract finish, go back. So this is called outsourcing. You contact before, someone will come to prepare your accounts, contract finish, that person leave company. Here, you recruit a permanent financial accountant who will take care of your accounting records time to time. That's the meaning of outsourcing. So outsourcing could be anything. Outsourcing could be a machine. All right. So let's say uh, you need a machine to make product. Option one, you buy machine. This is called insourcing, and you use machine to make product. And second option is you rent machine. You take machine on leasing for 6 months, 1 year, 2 year, contract finish, and you give that machine back. That could be outsourcing, right? So outsourcing is not just for material, outsourcing for any kinds of things that you need it. It could be in form of products, or it could be in form of service. All right. So that's the ideas behind insourcing versus outsourcing. So is it clear? Any question? So any other question, or we move on? Any other question, or move on to D? Say something quickly. Okay, so move on. So the last one is continue versus discontinue. Continue versus discontinue. This one could be for branch, or could be for product, or could be for service, for anything. All right, it could be for anything. So let's say I give example of a product. So for example, I have two products, A and B, and we don't have any problem about constraint resources. We don't have any problem. We have a much resources. We have enough resources. That's enough for meeting the demands for product A and product B. I repeat, product, we have two options, product A and B, and we don't have any problem for constraint resources. We have unlimited resources, right? Let's assume. So you have product A and product B. So product A is a profitable, and product B is not profitable. So non-profitable. You're making money. If you sell this product, you're making loss when you sell this product. So now the question is, we have to think about it. We have to make decision. Decision is we should continue making and selling even though we have loss, or we should discontinue. We should discontinue because we're having a loss. So what decision we have to make it? And maybe some of you will say that, yes, of course, we should not produce product B because product B has a loss. If you say so, you are wrong. All right? We cannot take quick action without analyzing the cost, total cost of the business for product A plus B. We should not make decision just simply looking at the loss number, loss figure. All right? Let me give you example. So let's say sales, variable cost, contribution margin, fixed cost, and net profit. Right? So we have product A, product B, and total. Total means total business. If you sell product A, product B, and you have total sales, total so on. So let's say product A, sales is $10, variable cost is 4, contribution margin is uh, 6, right? And fixed cost is total. Remember, we are calculating for total, not per units, total, right? So keep in your mind, fixed cost is the total. So let's say it's include rent and depreciation for machine. So I'll give you 2 examples. Of course, when we pay rent for whole factory. All right. So remember all this total. When we pay for depreciation is a total, right? So let's say fixed cost is 4, and product A, $2 profit, because product A has a profit. That's what I said. Product B has a loss, what I said. So product B, I think it's going to finish. Is going to finish. Better we stop and then I will continue, otherwise I have to write again. So let's stop this one. Okay, so here is the question. So for example, you have 2 products. As I said, product A is profitable for you, right? Product B is a loss. Now the question is, we should continue, means keep producing product B even we having a loss, or we should discontinue. We should stop because product B having a loss. So we should stop producing product B. Okay. Now, look at here, C. C means if you continue product B, what will be the total impacts if you don't stop? You keep producing, even though being having a loss, keep producing. So you can see if you keep producing B, total sales, total variable cost, total contribution margin, total fixed cost, and you having a profit total. If you discontinue, if you continue B, keep producing B product, overall, your business having a profit. But if you decided to stop product B, so sales for product A, because B you are not producing, variable cost also decrease, sales decrease because variable cost decrease, variable cost relevant, reduce, contribution margin. Now, fixed cost. If you stop producing product B, fixed cost, before fixed cost divide, let's say rent is $8. Rent is $8. $4 here, $4 here. But you stop producing product B. So all $8 will comes here. So as a result, your fixed cost increased. And as a result, you having a loss. So which means even product B, you have a loss, still you should produce. All right. So conclusion is should not stop product B. We should continue with product B, because if you stop it, overall business has a loss. If you stop, your business will have a loss. But if you continue, even though product B having a loss, your business has a profit. That's the ideas behind continue versus discontinue. Same thing happen, could be two different branches. Same could be happen, two different segment in one company. Two different departments, two different production departments in one company. All right. So that's the ideas behind continue versus discontinue. So never say that even your product having a loss, we should not stop. We have to analyze it. That's the meaning of analyzing it. So remember, it doesn't mean that if business product having a loss, we should continue. No, I'm not saying that. I'm saying that we need to analyze it, the whole picture. So that's what we are doing here. What's going on here? What I'm doing here, I am analyzing my cost. I am analyzing cost to make my decision. All right, I'm analyzing cost to make a decision whether I should continue or discontinue. So without making any kinds of analysis, we should not rush to come to the to the final conclusion. We have to analyze all the kinds of information, of course, about cost, in order to, if you want to estimate that you have business having a profit or loss. Right? So that's all about your D, last method. So it's finished. Okay, now students say that why don't we produce more A compared to B? Maybe that's enough demand. No more demand for product A. That's it. Remember, this is not a per unit, it's a total, right? Maybe there is no more demand for product A. Customer don't want to buy product A more, but maybe customer demand for product B. Right? If customer will order more product, then of course it will be profitable. Right? So let's say we have a limited demand for product A. That's why we can't produce more. All right. So any question? Now keep in your mind your topic 5 is finished, right? So remember last time I said that I will give you calculation for marginal costing and absorption costing. So don't worry about it. All right. I may not ask in your exams the estimation for marginal and absorption costing. I think that's enough. All this kind of information is enough for your final exams informations. Right? So now if you have any question regarding topic 5, please ask me. So topic 5 is finished. No more information for topic 5. So next week we have 2 sessions. So I hope you remember. So I will send you Zoom invitation for next week. So next week we're going to have 2 sessions. One will be on Tuesday afternoon. All right. What will first will be on Tuesday afternoon, and second will be on a Saturday afternoon. again, why should not stop product B? Okay, I repeat this question. So someone asked me question is, student asked me that why we should not stop producing product B. Okay, if you stop producing product here, if you stop producing product B, that will be impact over business. So if you stop producing product B, sales, only product A. Variable cost, only product A. Contribution margin, only product A. Remember, it's a total for business, all right? And for A is $4, for B is $4. As I said before, total fixed cost is 8. Let's say factory rent is $8. So in this $8, let's say we charge 50% and 50%. For example, company decided 50%. So means $4 here and $4 here. But since you stop producing here, this $4 will shift here. So which means it's become $8, right? So as a result, your business having a loss. If you stop producing product B, overall, your business will have a loss. So we should not stop producing product B. We should continue product B. All right? Is it okay? Is it clear? Is it clear? Say something, yes or no? Okay. So topic 5 is finished. So today's lecture is finished. So now I'll see you next week online on Zoom, either on Tuesday, some of you on Tuesday, and some of you on Saturday. So I repeat again, next week is the last week, right? Next week is the last week. So next week is the last week. So we have class on Tuesday and Saturday. Please do not attend everybody either here or here. So if you belong to Tuesday class, you come to Tuesday. If you belong to Saturday class, you join Saturday class. So Tuesday, we will same time, 2:30 to 5 p.m. And here, same 2:30 p.m. to 5 p.m. All right. So remember, both lectures are a revision. All right. So it's the same, no matter here or here. So either you attend here. You don't have to attend both, only Tuesday or only Saturday, right? Revision. So in this revision, of course, I will talk about your final exam. All right, final exams, and then so on. So can you tell me, do you have any information about your final exams, any date or anything? Did you receive any email or any information from university? Did you receive any information regarding final exams from university? Any date for your final exam? Please say something. Okay, so I will speak to the office this week, and the next week I will, in the revision session, I will inform you the date for your for your final exams. All right. So any other question? Any question? If no question, can we stop now? I see your exercise said, make sure you don't listen my my video carefully. Someone asked me this question. Someone asked me this question. Make sure you don't watch my video carefully. VMC stands for Variable Manufacturing Cost. VNMC, Variable Non-Manufacturing Cost. FMC, Fixed Manufacturing Cost. FNMC, Fixed Non-Manufacturing Cost, right? So these are variable, manufacturing, non-manufacturing. These are fixed, manufacturing, non-manufacturing. All right, so any other question? Any other question? If no question, then can we stop now? I'll see you next week. Okay, so I'll see you next week. So next week, Tuesday or Saturday, right? And then we will talk further. Okay, I'll see you. Thank you.